All right, so welcome. We're just getting people registering right now with the link going live. So we'll wait a few minutes before we get our presentation underway, but I'll just start by welcoming those who are already here. My name's Amanda Morrall, and I'm the Head of Communications and Education here at Simplicity. This is our third webinar that we've done this week, and they've gone really, really well so far. So great interest, great engagement, and we're really happy you could join us for this one. We've got Andrew Lance, our Chief Operating Officer, and Sam Stubbs, our Managing Director, with us on this webinar. The way we're going to conduct it is we'll hear some opening comments from Andrew on what's happening in the market today. It's changing every day, moment by moment, so hard to keep up with, but we'll just get a bit of a summary. And then followed by that, Sam is going to give us a bit of a presentation, about a 10-minute presentation with slides. And then we're going to open it up to you folks out there to get your questions answered. So there are a couple of different ways you can send us a question. At the bottom of your screen, you'll see a little Q&A bubble. So if you write into that, that will populate the question on our end. Don't type too quickly because it'll break out your questions. So just make sure you've got your question in full before you submit. If you're not too shy and you want to ask us a question live, then if you raise your hand, that's another way that we can get around to answering your question as well. It's kind of nice to have a bit of a mix, so please feel free to shout out with your questions. There's no such thing as a dumb question. They're all valid, and in fact, the ones that people probably are most reserved about asking are quite often the ones that people are thinking about and just too shy to ask. So we welcome you to do that. So we've got about 50 people online. We'll, I guess, get cracking here now. I'll just, Andrew, after your opening comments, I'll just break in again and tell people the different ways to join and ask their questions. But I'll pass the baton over to you at this stage, and if you can tell us what's going on out there in the markets today.
Sure, thanks, Amanda. Hi, everyone. Thank you very much for logging in. And today's been a very steady day compared to the volatility that we've had so much over the last few weeks. Last night, the international markets were quite strong initially, but towards the end of the day, faded. There was just a bit of announcement about the death rates in places like the States and the UK, which the market got worried about. That's the way things are at the moment. We're reacting to each little piece of news. And so from what had been quite a good day, it turned out to be a virtually unchanged day across the globe. And as I say, so far this morning or today, the Australian market's a tiny bit up. We're a little bit up. The dollar is reasonably steady. There's a bit of an announcement about Australian banks having a credit downgrade. Came through earlier today, but it was only the minor agency and nobody seems to be too worried about that. So that's been about all there is to ripple the markets today. Back to you, Amanda.
All right, thanks, Andrew. Yeah, again, things are a bit of a roller coaster ride. So, but overall, our message to investors has been just to buckle up and try to hold the course. It's this particular event has been a really good opportunity for people to get engaged in KiwiSaver and their other investments, to understand what they're actually invested in and to understand the risk that they've taken on in each fund. So we would encourage you to continue to do that. If you haven't already looked a little bit deeper into your fund profile to figure out whether it's appropriately matched to your circumstances. So for those who are just joining us, there are two ways you can ask us questions, and we'll take those questions after Sam gives his presentation. But at the bottom of your screen, you will see a little bubble, and you can tap in your question there. Alternatively, you can raise your hand, and that will enable you to break into the video, and you can ask your question, if you're brave enough, live. So two means of getting your questions in, and we welcome all questions. So Sam, without further ado, over to you.
Great, thanks Amanda, thanks Andrew. Folks, I've got a little presentation here. It's only about 10 slides. It's really quick, and it goes through what we've been through here now and what to look forward to in the future and what we think will be happening. You know, one of my favourite quotes is from Winston Churchill. He said, those who forget the lessons of history are doomed to repeat them. So what I'm going to do is just show you a slide here of history. We'll just get to the screen share here. Make sure, I just confirm that's all right, Amanda?
Looks good.
Great. Okay, so here's a chart. I just want to spend a minute looking at this. I don't usually do a lot of charts and graphs, but I'll just do one here. This is a really interesting one. This shows 100 years of the Dow Jones Industrial Index. So it basically shows 100 years of the US stock market. And just to show you what it is, if you look at those grey columns, those are the recessions. So that's when the economy's gone into recession, and the blue line is what's happened with the stock market in terms of the value of the stock market. I just point to two interesting things there. One is the Great Depression you'll see back in the 1920s there, where you saw the market collapse 80% and a very, very long, a very fat grey bar there. Then right at the top right-hand side there, you'll see where the coronavirus, the impact on the market has been. And as you can see, it's actually way smaller than the impact of the depression. The other interesting thing is hasn't been a grey bar for a while. The last grey bar was the global financial crisis there in 2008. So we've had a long time without a recession, and in the context of history, quite a long time. And so, you know, there's this phrase, we were due a recession. Well, we're about to hit that right now. But I just wanted to show you this chart just to put this into perspective, because even though now there are huge headlines and, you know, there's a lot of fear and anxiety out there, in the context of what has happened in history, this is not particularly dramatic and not particularly unusual, and the markets have recovered quite quickly. Now, what has the impact of that little down market, you know, the effect of coronavirus being on our funds? Well, I'll just show you this now. And you can just let your eyes surf around this, but you'll see KiwiSaver funds in the first block there, and then our investment funds. And as you'll see in the latest month, every fund has gone down, and that's no surprise. But if you look at it on a 1 year basis, go over to the third column from the left there in 1 year, you'll see that actually most of our funds are still up for the year, and those that are down aren't down very much. And what's interesting is it's one of those really weird years where the growth funds have underperformed the conservative and balanced funds. But if you go right over to the 3 year annualized column, the far right-hand column on that KiwiSaver scheme, you'll see there that over 3 years, even though we've had this major correction, growth funds have still outperformed balance and conservative funds. So that sort of validates the thesis that if you're a long-term investor, you should be thinking more about growth assets, because you'll get rewarded no matter what happens in the short term. Now, we'll find out how those returns have done versus our competitors in the next couple of weeks, but the looking that we've done is we seem to have done very well across the board. You know, there's that split end songs, you know, history never repeats. Well, we don't think history will repeat here too much either, in the sense that if you have a look at every one of these market corrections and these recessions, each one is unique, and this one is unique in the sense that it is a medical issue. It's not a financial markets crisis. It's not a depression which is driven by over leveraging or a crazy stock market. This is a very medical issue. So when the medical issue gets resolved, we think the markets will go a long way towards recovering. We would caution against paying too much attention to what you read in the press on these things. Economists nearly always get it wrong. There's a joke that economists have predicted 11 of the last 3 recessions. And in these, and as is in the nature of the media, bad news will always get attention. And there tend to be a lot of commentators out there jumping to paint the most, pessimistic scenario of what's going on right now. In fact, there are even some people talking about depression right now, and we think we're miles off that. The Great Depression was caused by the government doing exactly the wrong thing when the markets turned down. What we think the governments and reserve banks around the world have by and large done is the right thing, which is actually, back in the Depression, they actually shrunk the economy. They went into an austerity program. On contrary, now what the governments are doing is basically subsidizing a whole lot of wages, putting a whole lot of money into the system. It's going to be painful. There's no question. We're in for a recession. We're not, gilding the lily too much, but we think a lot of good will come from this as well, and we can talk about that later. The government reactions, as I said, have been pretty good, and so just think recession, not depression. There are some key questions for investments right now. How long will this global lockdown last? How long will the medical crisis last? And the answer is we don't have a clue, and I don't think anybody does. And anyone who pretends they do as well, maybe they're a medical expert and know better than most. But this is the huge unknown here right now. So expect the financial markets to continue to be volatile. They may go up and they may go down. They're likely to do both. And they're likely to be, there'll be periods of great volatility and some fear in there. And what happens to fixed interest and shares and property and all those other investments, people just don't know. We think basically timing markets is a fool's game. If you try to pick the direction of the market, you are usually going to get it wrong. But there are things you can do now, which are the things that you could do beforehand, which really work in your favor. So if you have very diversified investments, for example, all of our funds have over 3,000 investments in 23 different countries. That's our balanced, conservative and growth funds, KiwiSaver and non-KiwiSaver. So diversify. Because some stocks will go down and some go up. So for example, we own Amazon in the portfolios, and they've done very well because obviously people are getting a whole lot of stuff delivered at home. The second thing you can use is dollar cost averaging. And by that, what we mean is you put the same amount of money in each week or each month, which most people in KiwiSaver do. And when the value of investments go down, you are buying more for your money. So it's like buying things on sale. And dollar cost averaging works very powerfully for you. And likewise, compounding interest. The fact that you stay in the market and you keep on getting the benefits of the dividends and the interest paid, they stay in, they get reinvested. Compounding interest is what Einstein called the eighth wonder of the world, and it really is a very massively powerful tool that still works for you. So one other favorite phrase of mine is that short-term markets are a voting machine and long-term they're a weighing machine. What does that mean? That means that in the short term, the markets will move a lot on noise and news and fear and all those sorts of things, very emotional reactions to what's going on. But long term, financial markets are a weighing machine. And what that means is they do respond to logic and reason and long-term thinking. So if you are prepared to wait, the markets will react rationally to what is going on. But if you are acting in the very short term, what you'll find is that financial markets over a very short period of time can make some quite wild movements based on not a lot of logic and on an awful lot of fear. So the trick there is just to be patient. Find the appropriate fund for you, keep on investing in it, do not pay too much attention to the media, and you'll be rewarded over time. The other thing, of course, is that fees are really, really going to matter in financial products. Let me give you an example. In the days when funds were making 10%, if a fund manager was charging a 1% fee, means for every $10 you made, $1 was going in fees. That's 10% of what you made was in fees. But if we're going into the modern world now, and I have no idea what the number will be, but let's say you make 4% on your fund and your fund manager charges 1%, that means 25% of everything you make is going to go in fees. So if fees mattered beforehand, they really, really matter now. And as you know, with Simplicity, we charge the lowest fees. The actuaries who work for the government have told us that we will make the average person we'll save them about $35,000 in fees over their lifetime for a KiwiSaver fund. That will because of compounding interest, because those savings stay in your fund, that'll compound up to about a $65,000 difference when people retire. That's what we're all about. So really, really focus on fees. The other thing too is, as you may know, Simplicity gives 15% of all the fees it charges to charity, and that really matters now. We recently gave $50,000 to the City Missions, the Salvation Army and Women's Refuge, and that's just what we do, and that's what we're going to keep on doing. And the more we grow, the more we can give to charity. And so these are some of the charities we're supporting. We've now, actually, this slide's a couple of days old, we've now donated over $900,000 to charity since we started 3 years ago, and we're just going to keep on doing that. And boy, if charity needed help beforehand, it really needs it now. There are a lot of people out there who can benefit from our donations. The other thing too is we're going to carry on ethically investing. We exclude these 8 sectors here in all of our portfolios except our Australian investments, and they will be excluded later on this year. And that has been beneficial in terms of returns. We can talk about that both in the long term and in the short term. So it's great for investor returns. You make more money as a consequence of this. And it's also very much in alignment with our members' values as well. So we're going to carry on doing that because it's a winning strategy. And all of that adds up to, what we're about and why we set ourselves up. We want to give people dignity in retirement. How do we do that? Well, people have more dignity in life when they have more choices, and they have more choices when they have more money. So our job is to make you more money, so you have more choices, so you have dignity. And it's as simple as that. So that's what we're about, and I'll just see if I can get out of that now. There we go. And that's me. Amanda, over to you.
All right, thanks for that, Sam. And I just wondered if this morning there was a report, or it might have just come out in the last day or two, that said relative to other countries around the world, New Zealand was well placed to recover from this a lot quicker because of our resilience level. We were even graded on an index. I think we came number 12 worldwide in that index on resilience. Did you want to comment on what it is that makes New Zealand a little bit more resilient than some other countries might fare through this crisis?
Yeah, sure. Well, the reporter rated us number 12, but I'll tell you, Amanda, there's no place I'd rather be than here right now. And the reason for the resilience is a number of things. First of all is, if you think about our level of government debt, it was very low. So the government can afford to borrow a lot of money to subsidise salaries and wages and small business loans and so on. Secondly, if you think about the New Zealand economy, while on the negative, we have a high dependence on tourism, we also have a high dependence on agriculture, and our agricultural exports are looking very strong right now, supported by a lower New Zealand dollar. And also, we have what I call resilience in our institutions. We're a well-functioning democracy. We have good rule of law. We have respect. We have a respect and a kindness and a fairness, which really comes forward in times like this and shows us to be, you know, a safe and great place to be where people look after each other. So, you know, there's a lot of reasons why New Zealand's a great place to be right now. I know it's going to be very hard for some people, and there are going to be some very tough things happening. But as a country, we're extremely well placed internationally.
Okay, thanks for that. Now, just for the benefit of those who might have joined us after a few minutes into when we started, there are two ways whereby you can ask your question. At the bottom of your screen, you will see a Q&A. If you type in your question there, that will pop up on our end, and we will answer all your questions, hopefully, today. You can also raise your hand, and that will give you the ability to break through and ask your question live, and we welcome you to do that as well, so please don't be shy about that. We've had lots of questions, and we're unable to get through a lot of the questions in the last two sessions, but people are looking a little bit shy here, but I see we've got one who's come through right now. From Tim Hodge, thanks Tim, who asks, if the New Zealand dollar is lower, what are the impacts on Simplicity funds, assuming many are valued in non-New Zealand dollars? Andrew, did you want to answer that one?
Sure, of course. So if you're investing offshore, you may or may not be aware, if you're investing offshore, there are two ways of doing it. You can either hedge your investments so that you don't have that foreign exchange exposure, or you are unhedged, so therefore you do have exposure to those foreign currencies. And what happens if you hold shares unhedged and the New Zealand dollar goes down, as it has done over the last quarter? That actually insulates you somewhat from that movement, because your New Zealand dollars, you're actually holding non-New Zealand dollar currencies. So when you translate that back to the New Zealand dollar, you get a benefit. The hedged New Zealand dollar portion of any share portfolio does move with the New Zealand dollar, so it will go down relatively if the New Zealand dollar goes down. And so the effect on our portfolios, we have 65% of our portfolios are hedged. So the 35% last quarter, the 35% that was unhedged, performed considerably better than the New Zealand dollar hedge proportion. But overall, the impact was never good. It's never good to get negative returns, but it was a little more bearable than we feared.
Andrew, I'll just ask another follow-on question for that for those who are unfamiliar with our hedging policy. Can you explain why it is we do 65%?
Sure. That's because our philosophy is always to try and make sure that we're not an outlier. We want to be in the middle of the KiwiSaver universe, and it's broader than that now with non-KiwiSaver, of course. And so we target the average hedging ratio of the major fund managers in that are the default managers and a couple of the other big ones. And that comes out at 65%. So we know that if we're hedging 65%, we're not an outlier. We're not 100% hedged. We're not completely unhedged. We'll be straight down the middle. And then members get the maximum benefit out of our lower fees, because ultimately we will be our returns will be the best in the market.
Okay, I'm going to try to take a question live from Peg. Peg, hopefully you can turn on your microphone. We've had some issues with people who didn't have their audio turned on at their end, but I'll just see if we can get you through now. And if you could turn on your audio from your computer. Peg, welcome.
Can you hear me?
We can hear you. Go ahead.
Great, great. And thank you for hosting this. I really appreciate it. I'm about to turn 61. I have a Kiwi saver that's in balanced funds, because that's what I've had for years. My question is, I'm hoping to retire by 65 or 67, and what's happened with the COVID virus has really rattled me. Should I stay in the balanced funds, or should I go to the conservative funds, given the fact that I'm hoping to retire in 4 to 6 years?
I'll just jump in and then I'll throw to Sam and Andrew, but we've reminded everybody who's been listening to our webinars that with each particular fund, we have suggested timeframes for those funds, with the conservative fund being 3 years plus, the balanced fund being 6 years plus, and the growth fund being 9 years plus. And the reason being is that those are the expected durations to override any volatility you might expect to see in that fund. So with your time frame for retiring on the horizon, the balanced fund, we can never say never, but you might be sitting comfortably within that period where you do see a recovery. The risk in moving out of your balanced fund into a conservative one is when markets, and they will recover, do recover, you might miss the pickup in the market and compound some of your losses. So it's always a hard one to know, but you would appear to be sitting within the appropriate risk group for where you're poised towards retirement. Andrew, did you want to elaborate on that at all?
Obviously that's exactly right. I'm a little nervous about the bond market over that sort of period, over the sort of 3, 4, 5 year period, because right now interest rates are extremely low, and they're likely to stay that way for some time, but they will have to rise eventually. And at that point, the income assets in a, if you're going to a conservative fund where it's about 80% in those assets, the returns are going to be subdued. They're certainly not going to be anything like they've been over the last 5 or 6 years. And as Amanda says, the danger being if a conservative fund only has 20% of its investments in shares, if that market does recover, and we believe it will, you'll miss out on a lot of that too. So we can't give you personalized financial advice. There's an awful lot more things to it, but in a very general sense, I would say, as Amanda does, that the sort of time frame you're talking about sounds about right for balanced rather than moving to conservative.
The other consideration, Peg, is that a lot of people tend to think that at 65 they're going to withdraw all their money and go on a one big holiday. But for a lot of people, they still have to think about a forward plan for that investment. That is, they might start making some drawdowns, but the rest is going to stay invested as well. So that's another consideration, that you won't be on your birthday withdrawing all your funds, presumably, unless you've got another plan to get you through the rest of your life as well. Sam,
you sound pretty sprightly for a 61-year-old to me, and statistically, you've got another 23 years to live before you even hit the average. So, okay. In terms of investing, a lot of people, I think Amanda's point's exactly right. A lot of people think about, when I turn 65, everything's got to be in the bank and fixed interest. Well, that'll earn you very, very little for the rest of your life, and you've got to live off that money. So maybe being in a balanced fund for right through your retirement may be appropriate too.
Okay, thank you all. I appreciate it.
Thanks, Peg. Okay, so let me take another question here from Mike, who says, a slight aside, why did the Dow Jones fall in the 60s and 70s with no recession?
That was, there was a period there called the Great Recession, actually. Over the 60s and 70s, and that was inflation. That was because the world was getting used to inflation, and inflation is a massive destroyer of assets. The only asset that can do well in inflation over a long period of time is property, and only if you borrowed a lot of money against it, so that the debt goes down as inflation goes up. So that was the problem in the 60s and 70s. The United States was also dealing with the Vietnam War, which was a problem and consequences of that, the recession that occurred after that. There was the oil shock of 1972 as well. So there was a lot of shocks in the system, and the oil crisis was a really big deal. In fact, I think someone's just put up a comment that there was an oil crisis as well, which is from Benjamin, which is appropriate comment. So yes, there's a lot going on there, which was very, very tough for the United States after a massive period of post-war prosperity.
Okay, so thanks for that. And I'll go to Sarah's question next. And Sarah asks, here's your stupid question for the afternoon. You talked about diversity with our investments. Can we assume that Simplicity's growth funds are diversified? Thanks, Sarah. There is no such thing as a stupid question. It's great that you're asking it. Yes, with regards to our conservative, balanced, and growth funds in KiwiSaver, they are fully diversified. All of them are invested in more than 3,000 assets spread across 23 countries. And so the key distinguisher between those fund types will be how many growth assets you have versus conservative or fixed income. So the reason why growth funds were most severely impacted during this crisis is because you're most heavily exposed to the share market. With that particular fund or growth fund, it's about 48% international shares. There's a great resource on our website. Well, just the fund update to start. If you hop onto the website, there's a little pie chart and it will show you your asset allocation in each different group. So you can have a look at that and compare that to the other types of funds as well. The conservative funds obviously have the less exposure, and those are the ones that weren't quite as badly impacted during this time as the balanced and the growth fund. Was there anything else you wanted to add there, Sam?
Well, we also have that great tool called Where in the World is My Money too. So if you go to the tools bar and you go, Where in the World is My Money, it will show every investment that you have and how much you have invested. So for example, it will show that you might say you have $15,000 in KiwiSaver. It'll show right down to the dollars and cents how much money that is invested in, say, Apple or any one of the other 3,000 investments around the world, and that changes daily. So it's a really, really cool tool. And I think it's possibly the only one of its kind in New Zealand and one of the very few in the world. And, you know, our Chief Technology Officer, Amir's got to be patted on the back for that. It's an amazing thing.
Okay, Nona Cheng asks when, and this is a very frequently asked question, and it is in our frequently asked questions, Nona, when adding money to the investment funds, how long does it take to clear and register? Thanks. And I'll know you've got this memorized now, Andrew, so I'll pass that one over to you.
Yeah, sure. And so your money is invested, it arrives in our bank account, goes into the fund overnight and gets the price the next day on investing. So it's virtually instantaneous. You can't see it straight away because there's this thing called unit pricing, which is done 2 days later to put a value on the units that you bought, but they're invested as at the market on that day. And similarly for a withdrawal, the day that it's received, it receives that price, but it then takes a couple of days to be processed and actually appear in your account. But in terms of when you give us that instruction, that's when the purchase or the sale is actioned.
Okay, I hope that answers your question, Nona. We did have somebody with their hand up, but it looks like they got shy again or have rushed off somewhere else. So the next one I'll take is from Charlotte Hurley, who says, my company matches my KiwiSaver contribution, which is currently set at 4% of my pay. I'm on fast growth, and my knee-jerk reaction is to drop my contribution to 2% rather than change funds to a more conservative one. I'm very lucky in that my job is safe. Any thoughts from the experts, please? Well, first off, Charlotte, I would say you're really lucky to get 4% from your employer as well, because most only pay 3%. So I'd personally be reluctant to shift down. You can't currently switch to 2%, only to 3%. 3% is the minimum for both yourself and your employer. So my own inclination is if you're otherwise okay financially, that is, you don't need access to that discretionary income and your job is safe, I'd say it's probably more beneficial to be continuing to get that extra little bit from your employer as long as it lasts, because you'd be a rare one getting that extra 1%. Sam, would you have any other comments there?
Oh, look, I think in what history will tell us is that if you carry on investing now, that you'll be buying stuff at bargain prices, but only over the long term, right? So if at all possible, you should benefit from this thing called dollar cost averaging and just carry on investing as you were beforehand and not being too concerned about what the short-term direction of financial markets are. But the other thing is it's a very personal decision, and it's how you feel. It's your money. And it's a bit of an emotional journey. There's this thing called loss aversion, which means that you hate losing $1 more than you love making $1. So there are just some people who hate the thought of losing money. And if that's the case, then maybe you should think about changing how you invest. But as a general rule, stay invested, carry on investing the same amount in the same fund that you were comfortable with a month ago, and you will get rewarded over time.
And thanks, Charlotte. I did notice you disclosed your age, and I'm at the same group, and I would share that I'm in a growth fund, and we'll be sticking and holding that course. But it is relative to your own preference, and there is some good resources out there. Risk profile questionnaire available on sorted.org.nz if you want to review your risk profile on one of those resources. It's not a bad idea to do it. Okay, so we'll go to Robin Caper, who says he's been surprised at the relative robustness given circumstances of the growth fund to date. Andrew, is this a function of a diverse portfolio?
Yeah, very much so. Very much so. We've benefited from having our investments, as we say, spread as widely as we possibly can. There has been one other factor, which is a little bit of a surprise that it hits so quickly, but particularly, and I was just looking at the results over the last year, our ethically conscious funds have outperformed the unscreened index. So our funds screen out the industries that Sam outlined in his presentation. And over the last 3 months and a year, our screened portfolio has outperformed the broader index by, well, it's almost 3% over the last 12 months. So that's contributed quite a lot, because particularly, as you say, in growth funds, we have a relatively high allocation to international shares. So that's done very well indeed. Coincidentally, the global bond funds also outperformed, but being bonds, it never does anything quite so interesting. So it's only outperformed by about 0.3. And so that's really encouraging. I mean, it will be a function, at least partially, of the fact that we strip the oil companies out of our portfolios. And not surprisingly, with the oil price down at $20 a barrel, the oil companies haven't done particularly well. But as I say, very encouraging to see that coming through.
Okay, and we've got a question from Elizabeth. So I'm going to try to go live to you, Elizabeth, just if you can make sure your audio is turned on. Okay, it looks like your audio is off. So if you could turn your audio on. Hello, Elizabeth.
Hello.
Welcome.
Hi. Oh, thanks for having me. So my question might be silly, and I might not have understood exactly how your transaction spread works, but I just wanted to know if there's any chance you can see how much you've contributed over the span of having a KiwiSaver versus the amount that I guess I'm trying to figure out if what I took out was the amount that I guess I deposited, or did I lose a significant amount? Unfortunately, I bought my house for my first house a couple of weeks ago. I settled on the 13th, just before the lockdown, and I know that was probably the worst time you could ever possibly settle your first house and do anything about it. I guess what I was confused about was the withdrawal versus the transaction amount. Does that make sense in terms of on your systems you have what you withdraw versus what the amount is? Does that make sense?
So you're talking specifically about the amount that was taken out towards your first home deposit? Is that?
So you can see how much, yeah, I specifically withdrew in terms of asking for the amount and left some in. However, where it says transactions, it says total withdrawal is nearly what was double my amount that I withdrew. So I think when I tried to investigate, it was really probably related to changing funds. Unfortunately, I didn't know that would be such a huge significant cost, but I jumped around funds really sillily in like the last 3 months, from growth to balance to conservative, before withdrawing fully, going from growth to conservative. Does that mean it sold my shares at that unfortunately lower drop when it was like the 22nd of February to like the 12th of March? It went down like 6% or quite a lot, and then is that what makes the difference of the dollar form? Is that how it works?
Elizabeth, if you have a look in the member login area under how unit pricing works, we do explain sort of the delays in the timing from the time that you put in your request to how that is valued. So there could have been a delay there, but without seeing exactly, maybe what we could do is take this offline and then explain it to you in a more detailed sense. Because if you had switched funds a few times in there as well and crystallized some of the losses, that also would have probably resulted in a reduced amount that you were expecting in there as well. So let's take that one offline, and then we can help you understand what happened there.
Sorry, Amanda, if I just make a comment, Elizabeth, you said it might be the worst time to buy a house. You might be right, but you might not be as well. It might have been a good time, because with house prices now, it's very debatable as to whether they'll go up or down. On one hand, we'll be going into a recession. It's not usually good for the price of houses. On the other hand, interest rates are likely to remain quite low for a long period of time, and no one is going to be building a lot of houses in the short term either. So what typically happens in recessions with house prices is they don't typically go down a lot. It's just that not many get bought or sold. So this phrase called liquidity, or the number of transactions, stops. So you never know. And over the long term, housing's been a great investment. So I wouldn't be overly concerned about your timing there. You're in your first home, which is just wonderful. And you may have bought at a great time. Wait and see.
Okay, cool. Thanks.
Thanks so much. Okay, radio. So we'll go to the next question here. Related to our graph. In the Simplicity website interface, I can see a graph showing the percentage return over time. I can also see my current balance. Is there a way to see my balance over time? Andrew?
I'm trying to remember if you can or not. Can you not change the date at the top of the summary page? And that will tell you what the date is. I don't think we haven't got a graph of somebody's balance over time.
Yeah.
But I think you can change the date on the top of the summary page, and that will show you the balance of whatever date you put in.
Yeah,
you can, Andrew. Yeah.
And then
so you can get your balance in dollar value and also performance over time by just changing the dates at the top.
Yeah, and then you can also export that as a transaction and see how the unit pricing changed in that period of time as well. So hopefully that answers your question, but feel free, if we haven't answered your question, to send us an email and we'll explain that a bit further. Okay, so question from Jeremy, who says, are you thinking about changing the hedging percentage to more than 65? For example, if the US NZ dollar rate was expected to head back to 0.65 in the next coming years. Andrew?
So we don't predict the direction of the dollar. In fact, we reduced our hedge ratio from 100% down to 65 some while ago, because the reason that you hedge the New Zealand dollar, we think, is because you get paid for that. Our interest rates are generally higher than the rest of the world, and that's how hedging is worked out. Now that our interest rates are virtually the same as everybody in the rest of the world, there was no benefit to hedging, so we reduced the hedge ratio to 65, and that's worked very well for us. If the market anticipates that the New Zealand dollar is going to strengthen against the rest of the world over the next 3, 4, 5 years, then they will increase their hedge ratio, and that's what we monitor. So we'll follow them. So we'll, again, as I said earlier, if you were listening, we don't want to be an outlier. We want to be in the middle of the market, because that way our fee differential, our fee benefit will definitely be to the betterment of our members. And so, as I say, if the general consensus moves to a higher ratio than 65, then we'll follow it.
Okay, I hope that answers your question. Now we've got another person wanting to ask a question live. So I'm going to sorry, I'm probably mispronouncing your last name, Venkabachi. All right, your audio appears to be muted, Venkabalj. If you can unmute your audio, and then we'll be able to hear you ask your question. Hello, can you unmute your audio? Okay, sorry, we had technical difficulties there. If you can unmute your audio at your end, we will come back to you because we can't get you through quite yet. I know that's a bit frustrating. Okay, so I will go to Tim Hodge again. I'm a happy Simplicity KiwiSaver investor and considering starting investing into your non-KiwiSaver funds too. Thank you. I like your charitable trust model, ethically invested and giving 15% of your fees to charities. Kapai. However, you seem to stand alone in the market on these. Why do you think that is? And I know you will love to answer that, Sam. So.
Sure. Well, it's because our competitors want to make money. So they're money-making businesses, and funds management, KiwiSaver management, is massively profitable. It's why when you walk into a bank, it's one of the first things they'll ask you about, because it's a very high margin product. So Simplicity was set up by a group of individuals, and they're all here, and there's another 13 in our team and another 57 volunteers, and we all decided to do it differently. We wanted to effectively make our members wealthier, not ourselves wealthier. So, and we followed a model which is very popular overseas with an organization called Vanguard, who do our overseas investing. They're the second largest asset manager in the world now, and they're also a non-profit organization. So we copied them. And yeah, so that's why we do it. We do it because we're sort of interested in making a difference. The reason other people don't do it is because ultimately they're interested in making profit for themselves or for the organizations that they work for.
Okay.
Simple as that, really.
Yeah. Okay, thanks, Sam. Another one from an anonymous member who says, as KiwiSaver money is invested, it must be making money, but for whom, as KiwiSaver itself is not interest bearing? Well,
I think that, you know, if you think about your investments in KiwiSaver, every dollar you invest is working for you. So one of the interesting things about KiwiSaver, and a lot of people know, is that we never touch your money. Your money goes to, in our case, the public trust, who are owned by the government. They hold your money in the investments that we instruct them to make on your behalf for your benefit. So even if Simplicity went bust tomorrow, which we won't, but if we did, your money would still be very safe. It would be held by the public trust for you. So I think that may answer the question, that ultimately every dollar that you invest is working for you.
Okay, I'm going to try to go back to our last member who had their hand raised. Hopefully they've resolved their mic issues. So we'll see if that, okay, you are live again. If you're able to unmute your audio.
I think your microphone is not on at the moment.
No, they're probably struggling. Sorry about that. We had somebody who couldn't figure out how to get that off earlier. So we'll go back to answering some other questions. Okay, this one is from Peter. He says, I agree with your comments about time in the market and to keep paying into our KiwiSaver. However, having just lost my job and with 3 months from 65, time doesn't seem to be on my side. Similar to your earlier question, do I get out early and try to hold and keep it for a few years if we can? So if you're in KiwiSaver, you can't get out early unless you made a hardship application. So, and there are people who need that income now, and we are seeing a slight increase in hardship applications. So that is a possibility. If you're 3 months, so you're not that far off anyhow. And if you've got no income, you won't be getting those deductions anymore. So at least you'll be spared from that. And so did you want to add anything to that, Sam?
Look, I think one of the advantages of KiwiSaver is, and in fact, we spent a couple of years lobbying the government for this, which is to say, look, people over 65 should be able to join it, and that it should be a whole of life financial product because it's so well supervised and managed, because the assets are safe for the custodian. So in terms of what you would do, yes, it sounds like very tough in terms of you making contributions until you're 65, and you'll be able to withdraw the money once you turn 65, but equally you could keep it in there for the rest of your life too. And lots of people do. They just choose an appropriate fund for them at that period. They still benefit from, you know, the diversity, the low fees, and having your money very, very safely looked after by the public trust in our case. So there's no particular reason why people need to get out of KiwiSaver when they're 65. My intention is that I'll just have it for the rest of my life. And I'll just do a regular monthly withdrawal when I retire, which I hope will be a long time away.
Okay. Right, I'm just going to go to some comments here because they were stacking up as well. Awesome to be in New Zealand at this time. Should we expect an increase in taxes to help with the government spending once everybody gets back to work?
Hard question. At the moment, no. The affordability of what the government has done, Moody's have just reaffirmed New Zealand's credit rating, said that we're in a very strong position. So it doesn't mean to say that there'll be a lot more spending on things. You know, spending will be tight, but the government can afford to do what it's announced so far, as long as we don't continue the lock-in. After that, well, they need to borrow more money. And look, every government has the option to raise taxes if they feel that they want to spend the money on something else, or in this case, repay the debt faster. So you can never say never. But in theory, right now, the government doesn't have to raise taxes in order to be able to repay what it's spent on, you know, salary subsidies and so on. But who knows what will happen in the future.
Okay, from an anonymous member, would now be a good time to take money out of government bonds and invest in a managed fund? Andrew?
Yeah, I mean, interest rates on government bonds are extremely low, as we've mentioned. They're basically all very close to, if not below, 1.5%. And so the returns you're going to get from those bonds over the foreseeable future are going to be subdued. It may be that they stay steady and the thing will tick along at sort of 1.5% for a while. And then therefore, that if the question is, do you sell them now? The question is then, what do you buy on the other side? And certainly over time, we believe the likes of growth assets will perform a great deal better than bonds will. It's timing. Right now, government bonds, as I say, are at extremely low yields. They would look like a good sale, but they're very safe. They're very steady. Your capital value is pretty much assured over the long term. It depends exactly what you're after.
Okay, and along those lines, Andrew, there's a question from Johnny J. Are there any plans to introduce a more aggressive fund, as wouldn't now be a good time to move to a more aggressive fund for those with long investment horizons?
Yeah, this is something which has been a fairly common theme, isn't it? And the idea, in fact, the irony being, some people have been asking if we could produce a cash fund, which is no risk in it at all. And we are considering it. We can't launch anything tomorrow, but it's something which certainly should be in there. It's just, it probably suits a far smaller category of people than the more diversified, sorry, not more diversified, the more less concentrated growth fund that we have at the moment. People that are looking for real aggressive are generally not as, there's not so many as there are for growth. Any thoughts, Sam? You add to that?
No, I think it's really a demand issue, and when we get enough people who want it, I think we would consider launching it. We didn't do it beforehand because we knew that only 1 or 2% of people would want a fund like that or even consider it. So, and you know, we're called Simplicity for a reason. We bring out products which are simple, easy to understand, and very low cost. So, but once we can get critical mass in that, we'll seriously think about it. Yeah.
Okay, thank you. I've got another question here from Rachel. she said, you've said timing the market is a fool's game. Does this relate to both depositing money and withdrawing? I'm interested in investing now, especially since the markets are low, and leaving money in for a long time. I'm in my 20s.
Right. Oh, well, saving money is always a smart thing to do. So no, you're not a fool by wanting to save money. So what I meant by timing the market, as I mean, is trying to work out, trying to buy and sell the stock markets or bond markets and trying to win by, you know, selling high and buying low or whatever. So that's, I mean by that, but in terms of short-term trading of financial markets, not the concept of saving so that you do this regular investing, dollar cost averaging. That's always a smart thing to do. That's never a foolish thing to do.
Okay, and we have a comment from someone who is asking for clarification on the graph that you used, Sam. Did I read the graph correctly? After the S&P dropped in the Great Depression in the 30s, it took 20 years to get back to the same level. Is this long recovery then likely to happen again?
Sure. Yes, it did after the Great Depression. Of course, people who were investing through those 20 years and using dollar cost averaging, of course, made a fortune. They didn't just get back to where it was. They actually made an awful lot of money by dollar cost averaging. But it took that while to get back to that level. Yeah. Look, could that happen again? You never say never, right? Could we be in a depression? Yes, we might be able to get in a depression, because who knows what will happen with coronavirus and other manifestations. Will it take a long time to recover from that? Yes, it will. If you're able to invest through that, you will have bought a lot of investments at a very cheap price if you do that. The chances of that happening, though, are very low. And the reason is that the reason that the Great Depression became the Great Depression was not because of a fall in financial markets. It was because what the governments and the central banks did afterwards, which is they did exactly the wrong thing to re-stimulate the economy. And everyone learns, you know, we get better over time. And so governments and central banks have worked out that the best thing to do is actually to flood the market with money, make sure people don't lose their jobs, stimulate the economy as much as possible, and also deal with the crisis as fast as possible as well, which is why we're in lockdown right now. So the responses of very, very powerful actors here. The central banks and governments have an awfully big role to play in the recovery of the financial markets. And so far, I think they've done basically the right thing, which is why, by the way, you've seen financial markets bounce quickly. You remember that phrase I said, markets are ultimately a weighing machine. They're now seeing through coronavirus, and they're saying, what is the world we're going into after that? And the world seems to be one of very low interest rates and economies around the world that recover in time. Andrew, do you have any more colour on that?
No. I mean, that point, that the answer to the question is very much that government action back in the 1930s was so badly managed. It extended the pain for so long and lasted right through till the Second World War. We'd really like to think we're not in that situation.
Okay, I have a question from Eves, who says, I have a KiwiSaver plan with another institution. Is it possible to transfer this plan to Simplicity? If so, when should I do that? And are there any risks in doing so? So absolutely, you can transfer to us at any time. It takes 2 minutes online. It's really that easy. You're not wedded to the first provider that you signed up with or were defaulted in. It's couldn't be easier to switch these days. As to any risks, well, all the KiwiSaver schemes are regulated by the Financial Markets Authority, and it's one of the most highly regulated financial products in the country. So we come under that purview just like any other does. And so in terms of risk, minimal risk there, we are fully licensed, etc. I would just want you to be comfortable with who you're switching to, and certainly sitting in a session like this and getting to know the people that are managing their money, how we communicate, and importantly understand the fund that you're going to be switching into would be a top consideration for you before you switch online. Sam, did you want to add anything?
And there are no transaction costs, right, Amanda? It doesn't cost anything.
To switch in, no. Okay, so building on the question, this might have been from earlier, I'm sorry, building on the question of a drawdown of funds, what are your views on the 4% rule? Would that help with the consideration of growth versus balanced, i.e. not needing all of the balance on day one? Andrew?
I'm not clear whether that is not needing all the balance on day one. I'm sorry, I'm really not sure what
I
I'm
think they're
picking up.
referring to being able to safely draw down 4% of your balance from retirement if you were in a fully diversified portfolio, and then being able to live. I think that's what I'm sorry, that question got broken up into two. So it was
Okay, no, that makes more sense. As Sam said, now if you're in that early or period just before retirement, your actual horizon is probably still 20 years. And as we said, our suggested minimum time frame for our growth fund is 9+ years, and 6+ years for the balance fund. So over the sort of time frame that people are in retirement nowadays, really the move to put things into much more conservative assets, completely understandable, but may not be in the best interests of the person over that long term. Balance is probably the slightly more conservative way of doing it, and probably very sensible. But equally, growth should be just as appropriate for somebody whose time frame to when they want their money to last for as long as possible. I mean, would you agree?
Yeah, I think that if you look at in investing, a lot of people generally go too conservative with their investments too soon, particularly if they're going to live for a long time, and so they miss out on the returns. And that's got to do with that thing I called loss aversion. People hate losing a dollar. They particularly hate losing a dollar when they're in retirement. So they're prepared to accept much lower returns. That is not necessarily, in fact, that is usually not the right way to do it if you wanted to maximize the money in your life and, you know, the dignity and the choices that you can have as a consequence of having that money. And so how you mitigate against that, how you stay in investments that will return higher amounts for a longer period of time, is you have diversification. You diversify it widely so that you are not exposed to any one particular thing or one particular company.
Okay, we've got quite a few questions here still. This one's kind of grabbed my interest. It's a bit of a comment, but also on the philosophy of investing. Thank you for hosting this, and sorry for the long question. Are we seeing an increasing disconnect between market performance and the real economy? With globalization, firms are producing offshore more, and this production isn't reflected in traditional economic measures such as domestic GDP growth. Yet these firms are increasing earnings and their share prices. Also, does the rise of tech taking up a larger weighting in stock indices, particularly in the S&P, add to this disconnect? Correct me if I'm wrong, but I feel like the value that such firms as Facebook and Google create for their shareholders isn't fully reflected in traditional economic measures. Do you think we need to change how we view and measure economic growth to adjust for the shift from industrial production to tech?
What a wonderful question. I have a few thoughts there. Andrew, do you have any on that?
Not particularly. I mean, we obviously invest in those entities that are benefiting from that trend, and I mean it's been a phenomenal trend, and I personally think that's why we've seen no inflation for so long, largely. So as I say, as those companies that we're talking about gain and create shareholder value, so they increase their weighting in the index, so we are investing more into them. So we're following that trend, but that's not talking about economic growth. That's talking about share market returns, which is exactly what he's talking about. Go on, Sam. This is much more philosophical, much more.
Look, I think there's this thing called the productivity paradox, which is that how is it that when we have the Googles and Facebooks and technology of this world, how is it that productivity and global GDP is not growing faster? Well, I think you've hit on a very important point there, which is that a lot of this stuff isn't measured in GDP, right? So take Wikipedia, what a wonderful resource, so much more efficient, but it doesn't move GDP by one iota, and yet it really has improved our lives. And likewise, when you look at the wellness budget of this government, what they're saying is, look, GDP doesn't measure the quality of a person's life, so let's try and do it a different way. So there are different ways of thinking about GDP now. what I'm reminded of a phrase by Churchill. He said, democracy is the worst form of government except for all the others. Well, GDP is the worst way of measuring economic growth and wellness except for all the other ways of measuring it. So until we come up with something better, we're going to be living in a world which I think you very accurately described, where traditional methods of measuring economic wealth don't relate to the world that we're increasingly living in, and will adapt, and it will get better. The other thing about inflation there in the world we're living in is, remember that we've had this massive period of ever low interest rates, and post the 2008 global financial crisis, a huge printing of money, which would normally lead to inflation. And I made a big mistake there. I thought inflation was going to come along, and it didn't. And the reason was imported deflation, so that China was just making everything cheaper. It was very, very hard for anyone to put their prices up. So while we haven't had GDP rise, we've also had a lower cost of living. So the amount of money that we spend on the necessities of life actually goes down over time. We have more discretionary income. It's not all people, clearly, but it is actually most people, and that's because we have imported deflation. So we are actually getting better off, even though it's not necessarily measured in GDP.
Okay, thank you. Could debate that one for a while, I think, that issue. I'm just taking another question from Elazar. Hi there, do you think it would be a good idea to invest more in KiwiSaver than the normal deductions, since shares are cheaper now? I'm in a growth fund and I wouldn't need the money in the short term. So absolutely, some people are choosing to do that to up their contributions. I would also say, just a reminder, that with KiwiSaver you are locked in till 65, or to when you use it for a first home deposit if you haven't already bought your first home. Alternatively, you might want to consider investing outside of KiwiSaver, because it's a bit more liquid for you if you should need that money for a shorter term or medium term goal as well. So absolutely, those who are in a fortunate position to buy are, and we are seeing a big rally in our investment funds right now, not surprisingly, for those people who are keen to get in on this market right now. So we'll take a couple more questions and I think we'll have to wrap it up. Somebody asking about Bitcoin. Do we want to get into Bitcoin? I don't think we have.
What, you mean Bitcoin as a desirable investment?
Well, Bitcoin, yeah.
Yeah, I know there are some Bitcoin zealots out there, and I totally understand what they do. Personally, I think a more reliable investment is a casino. I'm not giving any of my money to something which exists in a place I don't know and can't see, feel, and touch it, which is completely unregulated, which requires the power of whole countries in order to generate it, and which is easily replicable and copyable in terms of other virtual currencies. So I'm not a big fan of it myself, but I understand that there are people passionate about it, and I'm consistently reminded of when it goes up, and then those people seem surprisingly quiet when it goes down. But yeah, it's not something we would ever consider.
I've got a question from Beryl asking about how KiwiSaver works when it comes to withdrawing money for your first home and the specific conditions and criteria around that. Beryl, we've got a whole bunch of classrooms under the Learn section. So I would just, you could fire off our question to our customer service team, or register for that particular home buyer's guide, and you'll get all the information fully resourced, full of links. It'll explain everything you need to know about how to use KiwiSaver to buy your first home and what the criteria is around that. So I would direct you to our Learn section. And a question from Julia, who says, hello, I'm 64 and I retired on the first day of the lockdown. I will get the pension in August. I'm in the extremely fortunate group that I have some spare money. And my question is, as I don't anticipate requiring this money for 9 years plus, should I invest in the growth fund or shares?
Well, Julia, we're getting into the realms of personal financial advice. It's very hard for us to say in your particular circumstances, but for people like you, for the class of people who are entering retirement, who don't need the money in that 9-year investment time frame, the growth fund sounds like a sensible option for you. Amanda, do you have any view there?
Yeah, absolutely. I mean, it really depends on your plans, your goals. Perhaps you want to earmark that money for travel or grandkids. So it's all really relates to your goals. And again, you've identified the duration of those particular funds. So if you're not planning on doing anything with that money within that period of time, you're comfortable with the volatility, then, you know, nothing wrong with going that route as well. So again, just depends what you want to do with the money. This is a funny question. Hi, Sam, do you have a Kiwi saver? If so, what percentage are you on? The only reason I ask is that with most things in life, I try to learn and follow the leader and follow is there a percentage that are proven to be the best to use?
Sure. So I'm very happy to share about my finances. I have two things I invest in. One is the house I'm living in. So I own that, and then the only other investment I have is the KiwiSaver Growth Fund, and we subsidise 3% here at Simplicity to our employees. So I put in another 3%, so I match that, and any other spare money I have, I spend on my kids, and on, you know, enjoying life and the general cost of living. So I keep it very simple, and I just go to sleep, and I have spent my life investing in a whole lot of different assets and all sorts of things. And now the fact that I have it in the KiwiSaver Fund, I know it's well managed, I know it's very diversified, I know the public trust of looking after my assets, I sleep very well at night, and it's proven to be a very good investment over time. It's done very well.
I'm on 4%, just for the record.
Are you? Okay. Andrew, what are you on?
I'm not going to say anything about Amanda being paid too much, but that's fine. No, 3 cents, same.
All right. Do we have time for one more question? Let me go through.
Well, I was just going to say, and our team aren't going to thank me for this, but if anybody's question has been answered and they want an answer, they can email us at info@simplicity.kiwi. And one of the team, and they'll second me in now to help, I expect, but one of the team will definitely help.
And they're an awesome team. And Amanda mentioned our Learn section, where we've got, how many different classrooms have we got now, Amanda?
We've got 10 separate subjects set up, and it's very easy. You subscribe, you get the email sent to you, and you can pick through them in your own time. No exams, and they're free.
And we've just heard from our head of customer services, who says very, very happy to take the questions, looking forward to it. So there you go. Awesome.
Well, maybe we'll wrap that up then. For those of you who would love to join us or would like to, or maybe would like to advise a friend to do so, we are running sessions, these webinar sessions throughout the lockdown period. So next week, Monday, Tuesday, Wednesday again, and same with the following week. You might not have seen those dates because when you pop into the Eventbrite listing, it doesn't come up with all the 9 dates. And we did forget about Easter, but it seems like Groundhog Day every day. So we're going to go ahead regardless on Easter Monday with our 9 o'clock session, just in case you need another investment fix. So feel free to register again, or tell your friends about this. And again, shoot us your questions. Our team will do their best to get back to you. But thank you so much to all of you for joining us. We really value your membership and Simplicity. You guys have made us grow amazingly fast beyond our wildest dreams. And we've got the highest engagement and customer satisfaction level out of any provider in the market. So we're really proud of that, and that's credit to our members. Sam, did you want to close with any last?
No, just thank you. We had a milestone today. We hit 40,000 members. So we had exactly 3 years ago. So as Amanda says, growing very fast. And so thank you very, very much for your support and talking about us. We don't like to spend a lot of money on advertising. Our budget's very small because it's your money, ultimately. You're paying the fees. So if you could just talk about us, that would be marvellous. Thank you very much for your support. Thanks for arranging this, Amanda.
Thanks, Amanda.
And thank you to Amir Bashir, our head of IT, who, as always, makes things go very smoothly for us on the technical front. So he's always behind the scenes making sure this all goes off without a hitch. So thank you, Amir. And
thank you, Amir.
We'll catch up with you guys soon.
Thanks, team.
Thanks, guys.
Thank you very much. Bye-bye now.